Hello, I'm Mark Abssy, Head of Indexing at Tematica Research, and welcome to the week ahead. So as we usually do, we'll take a peek at what happened last week and then move on to what is grabbing our attention looking forward. So last week, apparently all's well in the world, 90-day pause on China, and everything's back to normal. I mean, at least that's what markets are telling you, right? We had the Dow up 3.4, S&P up 5.3 roughly, NASDAQ up over 7, even small caps up about 4.5. What I do like about what happened last week, I'm not crazy about going back to kind of pushing valuation envelopes and indications of overbought markets, but even in a week where we saw Nvidia up 16%, we saw Tesla up 17%, and the rest of the Mag 7 up considerably, Meta up 8, Alphabet up 8, almost 9, depending on the share class, Amazon up 6.5, right? When you look at the S&P 500, and I'm using the ETF SPY as proxy here, the ETF itself was up about 5.3%. Even with these big numbers coming out of these absolutely gargantuan names, when you look at the top 10 contributors to return for SPY over the week, it includes all the Mag 7. It also includes JP Morgan and Broadcom. Don't forget Alphabet has 2 share classes, so it technically takes 8 spots there. I mean, the Mag 7 does. So even with those outsized returns from a couple of very big names, the contribution of the top 10 to return on the week was a little over 50%. And there's certainly been a lot of times where we've seen that number be well over 100% of the return, 100, 110, 150, sometimes even more. Another indicator that this was more of a broad rally is you look at the advanced decline line for those S&P 500 holdings. To be clear, S&P 500 actually has 503 names, so if you're doing the math at home, the advanced decline line was 446 over 57. Again, very strong numbers and showing a broad rally, right? Lots of participation there, even on the Dow side. Their advanced decline 28 over 2, right? The only two laggards there in the Dow were Johnson & Johnson and United Health Group, which continues to have issues. You saw the news that their current CEO has stepped down somewhat abruptly. They've brought back, I think, a previous CEO. However, I mean, the name was down like 23% this week. So not a good week for United Health. The only silver lining, pewter lining maybe, is that when you look at how beat down that name is, it used to be the most expensive name in the Dow, and I harp on the price because don't forget the Dow is a price-weighted index. So that United Group's price now is cut significantly. It also means that its weight in the index and its impact to that index level has also been lowered over the last 4 to 6 months. Okay. So also on the model side, in as much as we saw strong returns, we saw tech as a sector up almost 8%, consumer discretionary up 7.5%. But don't forget, tech has 3 of the Mag 7. Consumer discretionary has 2 of the Mag 7, right? Amazon and Tesla. And so when you look at some of these models, some of these strategies, honestly, they're doing well ex Mag 7 names. CHIPS Act model up almost 9%. Nuclear energy and uranium up 8.7. Cloud computing up 8.3. Right? So, our philosophy on these strategies, on the models, and in thematics in general is that, thematics done correctly are capturing secular trends, right? Long-term trends of underlying economic activity that ultimately are driving the economy and driving markets, right? And even though we've had a very strong week, we see some of these strategies really outperforming even again, a very strong week. So these kinds of markets, these kinds of results are why we are interested in thematics. We know that sometimes they get a bad rap because, oh, it's crazy, they're crazy, who knows, is that even a thing? Which, by the way, is what somebody told me when I was pitching them the cybersecurity index back in 2012. Is that even a thing? But I digress. Bottom line is thematics done properly, thematics done well, are important and can give you insight into what is truly driving broader markets and broader sectors. Okay, so I'll get off my soapbox for now. Looking to this week. So it's a pretty light week from an economic data perspective. We really only have figures coming in starting Wednesday. Initial claims and continuing claims, I don't think that there's any big hit or bounce expected there, kind of status quo numbers. Thursday, we're getting May Markit PMI figures, both for manufacturing and services. The market figures have kind of stayed above 50. They've kind of flirted with 50 in the last round. These are looking to go higher, which is good. Now, one thing that I do want to get into a little with Markit versus ISM is that there are the two main vendors for these figures. Markit's survey is a lot more broad than ISM's in terms of the type and number of companies that it queries, and also Markit truly only looks at U.S. activity, right? So ISM, smaller number of companies, generally larger in terms of market cap and activity, and even though they do look at U.S. companies, they do also include all the global activity for those companies. So ISM, more global. I mean, if you really want to bullet point it, ISM, more global. Markit, more U.S. focus, wider range of companies that they look at. Okay. Thursday, like I said, we got Markit PMI. We have existing home sales coming in as well. They're expected to be higher by about 50,000 units, which would bring that total up to just under 4.1 million. And that's good. It's going higher. But I would point out that, pre-COVID, that kind of seasonally adjusted annualized rate is more like 5.3 million. So we're a little under a million short, or a little over a million short pre-COVID. Again, still moving and in the right direction, but just to put a little bit of perspective on that. So brings us to Friday, and again, building permits. It's just going to be the final number for April, and again, it's interesting because when you look at it pre-COVID, we're actually generally higher now post-COVID than that figure was pre-COVID, right? And of course, building permits, feed into a lot of consumer discretionary, consumer staples names, as well as a whole bunch of other names across, the spectrum. So that is good. And then earnings. Okay. Now, a couple things happened over the weekend, and one of which I'll talk about at the end, which is Moody's credit downgrade. But the other is for the second time in as many administrations, Walmart has agreed to subsidize tariffs from their own profits. Okay. Now, there was concern about, tariffs and inflation, and is the consumer going to want to, or can they even absorb these costs? Walmart has decided to kind of fall on the tariff sword, if you wish, and just, like I said, subsidize tariffs for their clients. Now, this week in earnings-wise, we got a lot of retailers coming out, so it's going to be interesting to see, of course, what they see going forward. But also any comments they may have about tariffs and what they intend to do with them with regards to, are they willing to absorb those costs? Are they going to be passing them on to consumers? How is that all going to work? So we'll hear from Target, we'll hear from BJ's, we'll hear from TJX, you know, big national retailers, and in TJX's case, of course, international as well. Urban Outfitters, Canada Goose, Ralph Lauren. Again, interesting to hear from these guys, especially Ralph Lauren and Canada Goose, a little more on the higher end. So we'll see if those kind of aspirational buys are still coming in for them, and of course what they see going forward. Another brand that'll be reporting is Deckers Brands, and if you're not familiar with them, they are kind of the umbrella company that owns UGG, Hoka, and Teva brands, among others. We're also going to hear on the retail side from Baidu, and of course it's going to be, again, interesting to see and hear what they say about what's going on, what their take is on tariffs and how that is going to impact them. Another Chinese company we're always interested to hear from is XPeng. Of course, with Tesla kind of having the woes that it's having currently in China, and of course China's push towards EV in general. Again, interesting to hear what XPeng has to say. On the housing front, we're going to hear from Toll Brothers, right? Really known for more of a high-end home builder, but we'll again want to hear what they're saying about tariffs. We're going to hear what they're saying about starts, permits, everything, right? And then, of course, along with that is Home Depot will be reporting as well, right? So we'll take in what Toll Brothers says earlier in the week. Later in the week, we're going to hear about permits, starts, and those kinds of things. On the tech side, we're also going to hear from Palo Alto, from Markit, and from Snowflake. So again, the talk will be tariffs. The talk will be what that's doing to build-outs, both on the AI side, on the data center side, and all those things. And we'll be here to hear what they have to say. So as far as the week goes, that's pretty much it. Again, I mean, the talk is still, tariffs, right? And we'll see what happens there. Now, before I leave you guys, quick word on Moody's downgrade of U.S. Treasury debt. So the kind of last leg of the AAA rated stool has been pulled out, where on Friday after the close, Moody's came out and said, hey, you know what? We really don't see the United States, the federal government, as a AAA rated issuer going forward. Now, it's interesting because there's really three major, let's call them major rating agencies. There's S&P, there's Fitch, and then there's Moody's, right? S&P pulled their AAA rating back in, I think, 2011 or 2012. It made such a stink that the then CEO actually ended up resigning from the company. Fitch pulled their rating, I think, in 2023, and now Moody's has pulled their rating as well. Now, going from AAA rated to AA plus or AA1 in the case of Moody rating, it's kind of like having your own personal FICO score go from 850 to 830, right? Let's not forget that the two key components, and there's a lot that goes into making the assessments on both of these components, but the two key components when assessing credit quality, right, are the willingness and the ability to make payments on your debt. Okay. A decade plus ago, S&P said, hey guys, debt's kind of high. There's a lot of debt here. How are we going to do this? The Fed responded by having a full decade of zero rate interest policy, and everybody had all the money they needed to make all the payments they needed, and everyone was happy. COVID came around, another huge infusion into money supply vis-a-vis debt, and Fitch put up its hand and said, hey guys, I don't know, it's a lot of debt here, but at the same time, the economy's still kind of chugging along, things are working, right? And anybody who's old enough will remember Ben Bernanke's comments about, well, we just turn the printing presses on. We can print as much as we want, right? So again, a lot of debt, but things were still moving along. So here now with Moody's, even more debt, right? Except the kind of big difference is, and Moody's did mention this in their note, this comes into the ability to pay part, right? The current administration is now talking about tax cuts and tariffs and honestly a lot of things which the folks at Moody's kind of crunched the numbers and said, okay, we understand what the goal is here. We're just not sure how it's going to happen and how it's going to unfold such that a AAA rating is still warranted. Okay, and again, going from AAA to AA plus, it's not a good look. There's a handful of countries that are still rated AAA. I think Canada, Australia, Norway, and Sweden. I think Germany. Luxembourg maybe, but it's not a lot. It's not a lot at all. So that's kind of my spiel there, right? It's not a huge blow, right? The credit rating scheme goes from AAA all the way down to D. Anyway, just some things to think about, and that's it for now. So hopefully you guys have a good week, and we'll see you next time. Bye-bye.